Good morning. Investor confidence and active lending support, our CRE outlook for 2026. And after a year of renewed momentum, U.S. commercial real estate is entering 2026 on more stable footing. And my 2026 capital markets outlook is for steady cap rates, improving investor sentiment, and sustained lending activity, which are setting the stage for continued, through the more disciplined, growth across most property types. So, for borrowers, investors, and business owners, this environment presents opportunity, but only for those who understand where capital is flowing and how lenders are underwriting risk in 2026. Let's look first at multifamily, the anchor of investor confidence. And multifamily remains the cornerstone of investor confidence heading into 2026. Cap rates are holding firm even as debt volumes expand, signaling durable demand and strong financing appetite. Agency lenders, banks, and private capital sources continue to support acquisitions and refinances, particularly for stabilized and workforce housing assets. And from a financing standpoint, this means competitive loan terms remain available and accessible, but underwriting discipline has increased. And sponsors with strong operating history, realistic rent assumptions, and conservative leverage are best positioned to secure attractive debt. Now, office, it's a measured but meaningful rebound. The office sector, after several challenging years, showed a notable rebound in 2025, and transaction volumes increased and institutional investors returned to select markets, particularly with major employment hubs in diversified economies. Now, while office financing remains selective, lenders are re-engaging with well-located, stabilized assets that demonstrate tenant retention as well as realistic releasing assumptions. And pricing expectations continue to reset, creating opportunities for buyers who understand both the asset and the capital stack. Now, let's look at industrial and retail. Stability and selective growth is the takeaway. Industrial assets continue to demonstrate stability across key fundamentals, and investor confidence remains strong, supported by long-term tenant demand, logistics-driven leasing, and predictable cash flow, which making industrial one of the most financeable asset classes in today's markets. We love them. And retail is also regaining attention. Retail cap rates have compressed alongside rising deal activity, particularly for grocery-anchored and necessity-based centers. And lenders are increasingly comfortable with well-located retail assets that show strong tenant performance and as well resilient foot traffic. Let's look at life sciences next, and capital availability is expanding. Life science real estate is gaining traction as both investors and lenders grow more comfortable with the sector. Consistent debt availability and expanding transaction volume are driving interest, particularly in markets aligned with medical, research, and university ecosystems. Now let's look at that monetary policy next. It's a supportive tailwind. On the macro side, monetary policy remains an important tailwind, with inflation moderating and labor market softening. Newmark has forecasted 2 Federal Reserve rate cuts in 2026, and I believe that's the consensus, while longer-term rates are expected to remain relatively stable. The shift toward a more accommodative stance supports transaction activity as well as refinancing opportunities for those facing maturities. Now, for borrowers, this reinforces the importance of timing, structure, and lender selection, not simply chasing the lowest rate. Now, let's look at debt markets. Liquidity remains the quiet strength here. Debt markets continue to provide a foundation of stability. And after a surge in lending activity in 2025, capital availability is expected to continue in 2026, just at a more measured pace. And banks are increasing acquisition lending, while private lenders expand their role in mezzanine financing, bridge loans particularly, and construction debt. Now, this layered capital environment allows deals to get done, but only when the financing is structured correctly. And that's what I can help you with. Here's the bottom line. Investor confidence, stable pricing, and accessible capital suggest that commercial real estate fundamentals remain intact heading into 2026. Now, however, the market is becoming more selective and opportunity driven and focusing on quality assets. For investors and business owners, success in 2026 will depend less on speculation and more on strategy, underwriting discipline, and proactive financing guidance. Glad to help you. Please visit billraponline.com to figure out how to get a hold of me. We'll talk about your scenario in detail. Have a good day.